Hey everybody, it's Daniel here from InfoRez. Hope you're all doing well. So, we got the Fed meeting coming up tomorrow, and let's talk about, expectations and what we expect for tomorrow's FOMC meeting. Well, the first things first is that don't expect major movements in the policy rate where we're going to get a rate cut. We're definitely not going to get a rate cut tomorrow, or I should say it's very unlikely we're going to get a rate cut tomorrow. Now, just because we don't get a rate cut tomorrow doesn't mean that they may not hint towards a future rate cut that could come in September. So we could see that, but most likely with Powell being the chair and his term coming up soon, it's very likely that we're not going to see that rate cut in tomorrow's meeting. Now, there's been other members in the FOMC group as well who advocated for rate cuts and advocated for having rate cuts actually starting tomorrow, and we'll go over one of the members and what they discussed in one of their speeches. Now, in terms of also the new chairman that we could see next year, the markets may not, whatever Powell says tomorrow, it may take it with a grain of salt, because we know and we've heard from Trump that he wants to change the chairman and wants to put in someone who's more dovish, who's more inclined towards cutting rates. So with what Powell says tomorrow, will it really truly affect the markets? Well, you might see some sort of volatility for sure, but the question is, will it be long lasting? That we are not 100% sure about. And I would guess that probably not so much, especially if we expect Fed chairman for next year to be more dovish and to expect some sort of rate cuts to come in, especially from more of a dovish Fed, right, for next year. So that will be very interesting. So we'll monitor and see what happens there. We'll monitor and see what comes out in terms of the dot plots, where the dots landing. Are we seeing more members show more dovishness, which might be taken as a very positive thing in tomorrow's meeting, right? If we see more members showcasing in the dot plot of more cuts that they expect more cuts to come. And then you could see, that be taken positively in the markets to maybe move up higher on that. So we'll wait and see what happens. But what I would like to share with you here's a speech that comes out from Waller, right? Christopher Waller. And it's titled "The Case for Cutting Now." Now, this speech came out, a while back, July 17th. And so, it's very interesting to see this, because Waller could be a candidate for him being potentially a Fed chairman next year. And it's very interesting because we've seen Waller become really, really, really dovish in the comments. Like, for example, I won't go through the whole thing here. You can read up on it by yourself. I'll leave the link in the description so you can do so. But what's very interesting here in the first couple paragraphs, basically he gets straight to the point, right? Basically saying, my purpose this evening is to explain why I believe the FOMC should reduce policy rates by 25 basis points in our next meeting. I used to tell my junior research colleagues that presentations are not murder mysteries. Just tell the audience up front who did it by telling them the main point. So let me follow my own advice, state up for the reasons why I believe we should cut policy rate at our meeting in 2 weeks. So first, tariffs are one-off increases in the price level and do not cause inflation beyond temporary surge. Standard central bank practice is to look through such price level effects as long as inflation expectations are anchored. It also says that GDP, real gross domestic growth, was likely around 1% in the first half of this year and is expected to remain soft for the rest of 2025, much lower than the median FOMC participants estimates longer run GDP growth, right? So basically saying that, around 1% in the first half of this year is expected to remain soft. We're going to see the growth softening. So why should we not be cutting rates? We should be cutting rates, right? Also starts off saying tariffs are one-off, so don't worry about inflation. We should be cutting rates. Final reason to favor a cut is the labor market looks fine on surface. So this is very interesting. He kind of mentioned a couple of things and some worries about the labor market, right? It looks fine on surface. Once we account for expected data revisions, private sector payroll growth is near stall speed. And other data suggests that the downside risks to labor market have increased. With inflation near target and the upside risk to inflation limited, we should not wait until the labor market deteriorates before we cut the policy rate. So basically saying that we should be cutting rates now rather than waiting for the job market getting worse off. And he says on surface it looks good, but when you look in other data, it may suggest downside risk to labor markets, and that is basically increasing. So basically hinting towards that you could see some weakness to come and continue to come in the labor market. So we should start cutting rates like right now. Now, if you go down in the speech, it talks more about this labor market. It says here, now let's talk about the labor market. The headline numbers from June jobs report looked reassuring. The unemployment rate stands at 4.1%, within range it has been for the past year. And payroll gains were reported as 147,000, essentially the same in May. But looking at it a bit deeper, I see reasons to be concerned. Half the payroll gain came from state and local government, a sector of employment that is notoriously difficult to seasonally adjust this time year. Basically what I was talking about, or what everyone was talking about in the last jobs report, is that the reason we saw that good number is because of the government data skewing it. And you have Waller basically saying the same thing. In contrast, the private payroll employment grew just 74,000, much smaller gain than previous 2 months. That is consistent with other surveys you might have read about and that found a drop in the private sector employment. And he also mentions to say that he likes to focus on the private sector employment, not only because it's the lion's share of employment, but because it's a better guide of cyclical movement in employment than counting public and private sector together. I don't know how much you can trust the ADP private report. The data tends to not be you can't really rely on it so much. So I wouldn't say I agree with this point, but the fact that he's mentioning, the fact that he's cherry picking data is just telling you where his head is and where he would like to see rates down the road. He's kind of pushing for rates to come literally tomorrow, rate cuts to come literally tomorrow. Now, what's really interesting is this line here. And there's another reason to cite slowdown in private sector hiring. A pattern in the data, so here it goes. A pattern in the data revisions in recent years tells us that private payroll data are being overestimated and will be revised down significantly when the benchmark revisions occur in early 2026. So there you go. He's telling you right there that this data that you're looking at, they're all overstated. They're false. They're wrong. It should be showing a different picture. They're all overstated. Therefore, you will see these revisions and you will see the change in the data in early 2026 to reflect the true numbers, the true pain that's happening in the labor market, which basically tells you that we are expected to see in early 2026 of the labor market to get worse off. And if that's the case, that sets up for the new chairman to go with more rate cuts for 2026, right? So we could see that where we could see a reason for further rate cuts in 2026, and to see multiple of them, especially if this data is going to show or reflect weaker numbers, right? So that will be interesting to watch in 2026. Another thing here, he did mention also, if I can find it, the data. So this is more related to the interest rate, and he's talking about that the median FOMC participant estimates 3% for the neutral rate, right? And he says we're basically 1.25 to 1.5% percentage points above 3%, hinting towards basically 4 to 5 rate cuts are definitely needed to get to the 3% neutral rate. Now, if you're going to get weaker data in 2026, if he's expecting 4 to 5 rate cuts, could we see more than that below the 3% neutral rate, right? This neutral rate was something that, was very difficult to get an answer from Powell, because it didn't really say explicitly. Now, you may say that, okay, we are at current neutral rate or not, but never really shared about the calculations and the mathematics behind it, and never gave us a concrete answer, except here Waller telling us it should be 3% and we are way above it. So that could mean 4 to 5 rate cuts, maybe even way more if 2026 data looks pretty bad. So pretty interesting to see this speech coming out for Waller. Could this all be politics just for him to get the position for Fed chairman next year? I don't know. Probably there's some of that in there, but if not, and if this is the ongoing theme among the FOMC members and all of them, and they're serious about it, then you can expect in 2026, if we do see that weakness in the data and the changes in the data and the revisions, then we can expect further rate cuts, and not just 1 or 2 or a slow amount of rate cuts. Probably we'll see multiple of them next year. Probably not the emergency rate cuts unless something happens like the Black Swan event. Probably we will start to see rate cuts, and then maybe if something breaks, emergency rate cut then. But we'll have to wait and see for that to play out. Anyways, so let me know what you guys think. Leave a comment below, subscribe, hit the like button and bell icon to be notified next video, and I'll see you guys around. Cheers. Bye.